Quantitative easing is something we've seen pop around the world ever since 2008 financial crisis. The US, UK, Eurozone, and Japan are just some of the countries that have implemented the unconventional monetary policy as a way of helping their economies recover from the recession. When the country starts to show signs of a slowing economy, the central bank will typically step in to try and boost business activity through expansionary monetary policy, which involves influencing the country's currency to encourage more spending and lending. Quantitative easing, or QE as it's commonly referred, is the process by which the central bank injects money into the economy. The money enters the economy through open market operations. That is, the central bank inserts itself into the market as a buyer and purchases securities in assets using its new money, typically buying government bills and bonds from other banks. This action increases an economy's money supply. The quantitative easing monetary policy has a lot of effects on global exchange rates. After the financial crisis in 2008, Americans started to implement the QE for the first time. The introduction of QE policy saved the financial market of the United States, promoting the economic recovery of the United States. The US dollar has depreciated greatly after 2008, and here is the data of dollar index from 2004 to 2014. Under the background of the economic and financial globalization, the economy of most countries around the world had been affected accordingly. Taking China as an example, during the quantitative easing policy of the United States, the Federal Reserve injecting a large amount of liquidity into the market, a large part of which flowed into developing countries, including China, in the form of hot money. This part of asset flow promoted the rise of the exchange rate and also increased the expectation of the international investors on the exchange rate. The substantial improvement of the global economy also promoted the expected appreciation of the RMB exchange rate. Under that circumstance, China has taken some actions to reduce the impact of it. China has accelerated the internationalization of RMB and reduced the use of US dollars for international settlements, which would reduce the foreign exchange reserves in US dollars. Also, it reduced the purchase of US Treasury bonds and started using China's foreign exchange reserves to buy high-tech technology. Next, we can move on to the monetary model of exchange. With the QE policy, the money supply increases. Look at this graph. If the money stock increases to MX1, whilst all other exogenous balls remains the same, it creates an excess supply of money at the old price level P. Note this excess supply money implies an excess demand for goods and services since we are assuming the output is fixed. The excess demand for goods drives prices upwards, which results in an increase in the domestic price level. This in turn results in the domestic economy becoming under-competitive, so the purchasing power parity to hold the currency must appreciate this depreciation. It is proportional to the increase in P. The end result tells us that in the monetary model, an increase in the money supply leads to a depreciation of the domestic currency. Let's realize the effects of an increase in the level of income. To sum up, the impact of QE on global exchange rate is very large, but countries around the world can implement some policies to reduce it. That's all of my presentation. Thank you.